Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com. As of last night, I had determined to do a strategy video on the British pound and talk about its unique proclivities and its ability to essentially offer a buffer to fundamental wins that weren't sourced from a particular area of the financial system, and that was concerns about Brexit. And it only makes greater sense, I think, today to talk about this because we have such a remarkable move. The British pound, as we can see across all the pound crosses, and we will look at a number of them today, marked a incredible rally. All right, now I'm not going to talk too much about the forecast for this here. I do it in today's trading video, so check it out there. But I want to highlight something specific out of this. I want us to take from this something that will be a little bit more useful over the medium to long term in dictating and understanding and determining whether we want to take pound-based trades and what would motivate those moves. The rally that we see here, which if you do a rate of change assessment, a one-day rate of change, which is essentially the movement that we had on this particular day, you'll find that this was one of the largest single-day rallies for the pound since way back in the 2008 extraordinary volatility period, right, during the great financial crisis, of course. This is remarkable. This is an exceptional move. And the motivation was explicit. It was Theresa May, UK Prime Minister, announcing that she was calling a snap election for June the 8th. In essence, she is looking to solidify the government towards a common negotiation stance in the forthcoming Brexit negotiations with EU counterparts. Whether or not this is going to work remains to be seen, but nevertheless, this is a theme that clearly matters to the market: Brexit. Right. Now, how does this alter the view on Brexit? Well, it insinuates that there could be a more uniform approach. Negotiations from the UK side can be more aggressive, or perhaps the running presumption is that this call to election will see Theresa May's mandate erode, and it will more universally guarantee a soft Brexit, if you will. So not losing access to the single market. Whichever way it leans, nevertheless, we learn that this is an extraordinarily important event risk. This is far more important from the pound's perspective and moving pound crosses than almost every other theme that we've seen activated. Now, it's true that not all the high-profile themes have been pushed to a overwhelming drive, such as risk trends, which we'll look at, but the contained bursts of activity from risk on, risk off, from monetary policy, from trade crises, essentially seeing major countries around the world, not obviously the UK versus EU, but other countries threatening to lock down in a protectionism shirt and a turtle shell. So I want to take a look at some of the crosses, and I want to show and I want to highlight a number of instances where we've had an exceptional move for individual currencies, other currencies, but the strength and the focus on Brexit has been so complete that even though Brexit was not motivated, it was not changing profile from being more or less bullish or bearish, it nevertheless kept the market steadfast through the release of the event risk. So the first place we'll start is the pound dollar, since we're already here. All right, I have two of the lines already denoted for you. November the 9th, that was the U.S. presidential election. A remarkable move on the U.S. presidential election. We had this from the dollar index, an incredible decline and subsequent rebound that instituted an extended recovery from the greenback. This played out very well for the euro. This showed through on currency pairs like the Australian dollar. It was a universal response. Universal, but for the exception of the pound. Not only did the dollar not generate its major move on the actual post-election day, but it saw the pound actually rise, whereas the dollar was theoretically rising against everything through that subsequent aftermath. Now let's move it forward two rate hikes that we've seen so far in the past 4 months. We had the December 14th rate hike for the Fed, and we had the March 15th rate hike for the Fed. Let's see how that impacted the dollar. All right. December 14th, that was a sizable rally with a strong fall through. That actually instituted the head component on the head and shoulders pattern for the dollar index. When you look at the Euro USD, that December 14th, December 15th move actually cracked the 105 level. A tremendous response and key technical move, or key technical break, but certainly not the full-scale follow-through. That was one of the circumstances we had discussed about the limitations of monetary policy. Taking a look at the March 15th rate decision, where we actually saw the Fed hike again and dollar drop, Euro USD rally. How did the pound respond in both instances? 2 days of decline for the pound dollar, so the dollar did advance, but clearly it wasn't of technical significance, not to the degree that we saw in the dollar index, nor in Euro USD or other dollar-based majors. The March 15th move did see the dollar decline, but clearly not to the same degree of intensity. So the dollar, one of the most liquid currency pair in the world, struggled for influence over cable because Brexit was acting as an anchor, not an active driver, not an engine of rally or decline, but an anchor. That's unusual. Typically, when there are multiple fundamental themes in the market that are engaging and distracting traders, the ones that are not active usually fall to the wayside and allow the active fundamental theme to take control. Not the case with Brexit. Let's take a look at another currency cross. We talked about risk trends. All right. From a risk perspective, we have seen a significant slip in sentiment, especially as of late. But when we look at some of the, a little bit further back, let's say we're looking at dollar yen, a good risk-oriented currency pair. You can also see this in the S&P 500 and other areas, but a big drop in risk trends, risk aversion. That cracked the aggressive momentum on the S&P 500 trend advance that you see here. And it was clearly replicated in other risk-oriented asset classes. But what about the pound yen? Pound yen, all right, on March the 21st. I have to go one by one because I can't even find it. March the 21st. Not a significant decline in any right. All the other yen crosses marked a substantial decline. S&P 500 and other equity indexes marked a significant decline. This can't even move with this kind of shift in sentiment. Furthermore, we have seen over the past weeks that the yen crosses have made a significant progress to the downside. Dollar yen, euro yen, Aussie yen, the list goes on. And what has the pound yen done? Well, as I repeatedly stated, it is the most frustrating of the yen crosses because it doesn't seem to commit to what other yen crosses are committing to. Why? Because the focus on the Brexit has kept it stationary, even though it wasn't moving until this past session with the snap election. Let's take a look at the euro pound. All right. Euro pound had a very significant head and shoulders pattern break, which I talk about more in today's trading video. But you can see that with Brexit, that comes a clear, very prominent technical development, clearing 84.50. But let's look a little bit further back. Let's look at a couple of euro-based events. First, we'll look at it in the Euro USD. All right. On December the 8th, we had this dramatic rally and subsequent decline. What happened? That was the ECB rate decision, which it suggested or said outright it was going to extend its quantitative easing program beyond its previous assumed stop date through the end of 2017. All right, that devalued the euro, sent the currency pair tumbling, and of course with the backup of the Fed coming just a week later, it would inevitably lead to 105 being taken out for the euro USD. But what happened to the euro pound on December the 8th? All right, December the 8th was a down day. Euro did get hit, but clearly not with the same degree of intensity. And again, this is a pretty universal move for the euro, and the substantial technical development after this news was pretty well recorded. But here we see the limitations that the distraction or the different focus could provide. How about going up to March the 10th? All right, when a report that the ECB was considering a possible rate hike before they end the quantitative easing program, obviously insinuating a rate hike sometime this year. All right. Whether or not it's likely, it was a response from the market, and it was given considerable credibility as the euro did rally. Obviously, thereafter, it was helped along by the March 15th rate decision, but that was a strong response from the euro. What did the euro pound do? All right, considering that this was no doubt a remarkable update and would skew the policy directions of these two central banks. It was a rally. It brought us up to that new high, but it would not accomplish much at all. So we just looked at the pound versus the dollar. And we had remarkable dollar event risk that produced significant technical breaks, remarkable rally and decline, and yet where it had substantial influence amongst the dollar itself and other dollar-based crosses, it would be buried in the pound dollar. We looked at the pound yen, where risk, certainly moving in starts and fits, and seeing more general jolting or volatility, but nevertheless seeing the electricity of those moves and that sentiment in yen crosses in other areas like the S&P 500, but we don't get in the pound yen. And then the euro pound, where the euro has found some traction on its monetary policy developments, and yet these are completely overshadowed by the distracted focus of euro pound traders who are looking instead to Brexit to mark their bearings, whether it even be up or down, or just a neutral course, a sideways in trading. Now, this is not absolute unique to the pound and the Brexit. This does happen where a fundamental theme seems so comprehensively necessary for dictating a bearing and an activity level for the market that it will override even active counter winds. Now, if you put up the pound against a full-scale risk-based trend, all right, you may not see the pound yen hold off as readily. But we're not seeing that just yet. We haven't tested the extremes of the focus, the distraction. In the meantime, in these relatively limited engagement views of fundamentals, we are only getting a refocus back onto the pound. All right, so if you're looking for pound-based trades, whether it be pound yen, euro pound, pound dollar, pound Aussie, pound Kiwi, which had some significant technical breaks, pound CAD. All right, those are incredible technicals. If you're looking for guidance on these and you're using fundamental analysis, there's good evidence here to suggest that you should dictate a lot of your assessment on the bearings of the pound. But what is incredible, this is another aspect that I go into more detail in today's trading video, is the fact that despite the intensity, despite the focus, the expectation for volatility for the pound dollar in the time frame of the actual election, which would be the blue line here, doesn't show much in the way of anticipation. I think this is underpriced risk, very underpriced risk. This was the lead up into the Scottish referendum. This was the lead up into the into the general election. Obviously, that was the Brexit vote. We still have time to get there, but this is still showing a very low anticipation, which is remarkable, and perhaps an opportunity into itself. All right, we'll wrap it up here, but remember this concept that sometimes fundamental themes can dominate others even when they're in neutral gear. We'll do our next strategy video tomorrow. Until then, I wish you guys good luck trading out there.